Another critical aspect of the future of money that often gets overlooked is financial inclusion. By 2035, money will be more accessible to people who were historically excluded from the traditional banking system. Millions of Americans today are underbanked or unbanked, relying on high-fee services just to manage basic finances. Digital money systems, mobile-first banking, and decentralized financial tools are already lowering those barriers. In the future, opening a financial account could take minutes instead of days, with identity verification handled securely through digital credentials. This shift could unlock entrepreneurship, investment, and stability for entire communities, reshaping how wealth is built from the ground up rather than inherited from the top down. At the same time, access does not automatically equal understanding. As money becomes more complex behind the scenes, the risk of confusion and misuse grows. By 2035, financial education will not just be helpful, it will be essential. Schools, employers, and platforms will increasingly be expected to teach people how money systems work, how digital assets function, and how automated tools make decisions. Without that knowledge, people may give up control without realizing it, trusting systems they don't fully understand. The future will reward those who ask questions and learn continuously, not those who blindly trust technology. Another powerful trend shaping the future of money is tokenization. Tokenization means turning real-world assets into digital units that can be bought, sold, or traded easily. By 2035, assets like real estate, businesses, art, infrastructure, and even future income streams could be divided into small digital pieces. This could radically change investing. Instead of needing hundreds of thousands of dollars to invest in real estate, someone could invest a few $100s in a fraction of a property. This doesn't eliminate risk, but it democratizes access in a way that was impossible before. As tokenized assets grow, liquidity will increase across markets that were once slow and rigid. Selling ownership in an asset may no longer take months, it could happen instantly. This speed will create opportunity, but also volatility. When assets move faster, emotions move faster too. By 2035, emotional discipline may matter more than ever. Easy access and instant transactions can lead to impulsive decisions if people are not prepared. The future of money will test patience just as much as intelligence. Another shift to watch is how trust is defined. Traditionally, trust in money came from governments, banks, and institutions. In the future, trust will increasingly come from systems, transparency, and verification. Smart contracts, open ledgers, and automated auditing can reduce the need to trust individuals or centralized authorities. This doesn't eliminate institutions, but it changes their role. Banks may become platforms rather than gatekeepers. Governments may act more as regulators than controllers. Individuals may take on more responsibility for verifying and protecting their own assets. Security will therefore become a personal responsibility. By 2035, protecting your money may involve digital keys, biometric authentication, and layered security systems. Losing access to money could mean losing access permanently if safeguards aren't in place. This will create a growing demand for tools and services that help people manage digital security without becoming experts. Just like antivirus software became standard for computers, financial security software may become standard for personal wealth. Inflation and monetary stability will also look different in the future. Governments will still influence money supply, but data-driven policy will become more precise. Real-time economic data could allow faster responses to recessions or overheating markets. However, faster responses don't always mean better outcomes. Mistakes can scale just as quickly as solutions. By 2035, debates around inflation, interest rates, and government intervention will be more intense, not less. People will pay closer attention because money will feel more directly connected to policy decisions. Another important trend is the blurring line between spending, saving, and investing. In the past, these were clearly separated behaviors. You spent money, saved money, or invested money. In the future, money may move fluidly between these states. Spending money could automatically earn yield. Savings could automatically invest based on risk preferences. Investing could automatically provide liquidity when needed. This fluidity could make money more efficient, but it also makes it easier to lose track of where your money actually is if you're not paying attention. Social and cultural attitudes toward money will also evolve. Transparency around earnings, investments, and financial decisions may increase, especially among younger generations. Money conversations that were once considered private or taboo could become more open. This transparency could reduce shame and misinformation, but it could also create pressure and comparison. By 2035, managing financial psychology expectations, envy, fear may be just as important as managing numbers. The future of money will also reflect changing values. Environmental, social, and governance factors are already influencing investment decisions today. By 2035, money may increasingly flow toward assets and systems that align with societal priorities, whether that's sustainability, ethical labor, or technological innovation. Money will not just represent value, it will express values. Where you put your money may say more about you than what you say. As all these changes unfold, one truth remains constant: money amplifies behavior. Technology doesn't change human nature, it magnifies it. Discipline, patience, curiosity, and long-term thinking will still separate those who thrive from those who struggle. The tools may be new, the systems may be faster, and the terminology may change, but the core principles of financial success will still apply. The future of money will reward those who adapt early, learn continuously, and take responsibility for their financial decisions rather than outsourcing them blindly to systems they don't understand. Looking further ahead, the relationship between money and identity will grow stronger. By 2035, your financial profile may be closely linked to your digital identity, influencing how easily you can access services, credit, housing, or even certain job opportunities. Instead of filling out forms repeatedly, your verified financial history could move with you, instantly proving reliability and trustworthiness. While this efficiency could save time and reduce friction, it also raises serious questions about data ownership and consent. People will need to be far more aware of who controls their financial data and how it is being used behind the scenes. Another major change will be how younger generations perceive money itself. For many Americans growing up in a digital-first world, money may feel less like a physical resource and more like a flowing system. This psychological shift matters. When money becomes invisible, it can be easier to spend without feeling the impact, but also easier to invest and plan automatically. By 2035, financial tools will likely include behavioral safeguards, such as spending friction or real-time feedback, designed to help people make better decisions without restricting freedom. The goal won't be to control behavior, but to gently guide it. Globalization will also shape the future of money in powerful ways. Even if you never leave the United States, your money will increasingly interact with global markets. Your retirement account may be invested in infrastructure in Asia, renewable energy in Africa, or technology startups in Europe. Currency conversion and international investing will feel seamless. At the same time, global shocks will travel faster. Economic events in one region could impact personal finances worldwide almost instantly. This interconnectedness will make diversification more important than ever, but also more accessible. The role of banks will continue to evolve rather than disappear. By 2035, banks may focus less on holding money and more on managing risk, compliance, and complex financial needs. Everyday transactions could happen through digital platforms, while banks operate in the background as regulated guardians of stability. Trust will come not just from size or history, but from transparency and reliability. Institutions that fail to adapt to user expectations around speed, clarity, and cost may slowly lose relevance. Another subtle but important shift will be how people think about debt. Today, debt is often viewed as either a necessary tool or a dangerous burden. In the future, debt may become more dynamic and personalized. Interest rates could adjust automatically based on income changes, spending behavior, or economic conditions. Smart contracts could restructure payments in real time to reduce default risk. This could make debt more manageable, but also more tempting. Easy access to flexible credit can encourage overuse if not handled carefully. Workplace compensation will also change in ways that affect money flows. By 2035, more Americans may receive part of their compensation in forms other than traditional salary. Equity, performance-based digital assets, or revenue-sharing arrangements could become common, especially in creative and tech-driven fields. This could align incentives more closely with outcomes, but it also shifts risk from employers to individuals. Understanding how to manage a regular or variable income will be a critical skill. As life expectancy increases, the concept of retirement will continue to evolve. Instead of a single retirement age, people may move in and out of work multiple times throughout life. Money systems will adapt to support flexible earning, saving, and spending patterns. Long-term financial planning will need to account for longer lifespans, healthcare costs, and changing personal goals. By 2035, the idea of one-size-fits-all financial planning will feel outdated. The future of money will also be shaped by regulation, often in response to crisis. Every major financial shift in history has been accelerated by disruption, whether economic downturns, technological failures, or geopolitical events. By 2035, regulatory frameworks will likely be more adaptive, using technology to monitor risk in real time. This could make the system more resilient, but also more complex. Individuals will need to stay informed about rules that affect how they earn, invest, and move money. Another important development will be the growing role of community-based finance. Digital platforms may allow people to pool resources, insure one another, or invest collectively in local projects. This could revive a sense of financial cooperation that was lost as systems became more centralized. While not a replacement for traditional finance, these models could provide alternatives that align more closely with shared goals and values. Ultimately, the future of money will not be defined by a single technology or policy, but by how all these elements interact. Speed, automation, globalization, and data will shape the landscape, but human behavior will still determine outcomes. Those who take time to understand how money systems work, question incentives, and think strategically will have a significant advantage. As 2035 approaches, the most valuable asset may not be money itself, but the ability to navigate a financial world that is faster, smarter, and more interconnected than ever before. As these systems mature, the emotional relationship people have with money will continue to evolve. For much of history, money has been associated with stress, fear, and scarcity. By 2035, while financial stress won't disappear, tools designed to reduce uncertainty could soften its impact. Real-time insights into cash flow, predictive warnings about upcoming expenses, and automated adjustments could help people feel more in control. When uncertainty is reduced, decision-making improves. However, there is also a risk that constant data and alerts create anxiety rather than clarity. Learning how to filter information and focus on what truly matters will become an important financial skill. Another change on the horizon is the way children are introduced to money. Financial education may start earlier and become more practical. Instead of abstract lessons, kids could learn through digital allowances, simulated investments, and real-world budgeting tools designed for their age. By the time they reach adulthood, managing money digitally may feel natural rather than intimidating. This generational shift could narrow knowledge gaps that exist today, but it also means future adults will expect systems to be intuitive and transparent. Financial institutions that fail to meet those expectations may struggle to gain trust. Insurance is another area where the future of money will quietly transform everyday life. By 2035, insurance pricing may become more personalized and dynamic. Instead of static monthly premiums, costs could adjust based on real-time data behavior and risk exposure. While this could reward responsible behavior, it also raises ethical questions about fairness and access. Money systems will increasingly involve trade-offs between efficiency and equity, and society will continue to debate where those lines should be drawn. The concept of ownership itself may shift in subtle ways. Subscription-based access is already replacing ownership in many areas of life, from entertainment to transportation. By 2035, similar models could expand into housing, technology, and even investment products. Instead of owning assets outright, people may pay for access, usage, or participation. This could reduce upfront costs, but it also changes long-term wealth accumulation. Understanding when ownership builds value and when access is sufficient will be an important financial decision. Philanthropy and social impact will also evolve alongside money systems. Digital platforms could make charitable giving more transparent, showing donors exactly how funds are used and what impact they create. Micro-donations and automated giving could become common, allowing people to support causes effortlessly as part of everyday transactions. This could reshape how Americans think about generosity, embedding it into daily financial behavior, rather than treating it as a separate activity. Another important factor is resilience. The future of money will test how well individuals and systems respond to shocks. Cybersecurity threats, technological failures, and economic disruptions will remain real risks. By 2035, resilience may be measured not just by how much money someone has, but by how adaptable their financial setup is. Diversification across assets, platforms, and income sources will act as a form of financial insurance against unexpected events. As automation increases, there may also be a renewed appreciation for human judgment. Algorithms can optimize based on data, but they don't fully understand personal values, life goals, or ethical considerations. The most effective financial strategies will likely combine automation with intentional human oversight. Knowing when to let systems run and when to intervene will be a skill developed over time. Cultural narratives around success and wealth may also shift. Instead of focusing solely on accumulation, success may increasingly be defined by flexibility, freedom, and alignment with personal values. Money will be seen less as an end goal and more as a tool for designing a meaningful life. This doesn't make money less important, it makes its purpose clearer. Political discussions around money will remain intense. Debates over taxation, digital currencies, wealth inequality, and government involvement in finance will shape policy decisions that affect everyone. By 2035, financial awareness will also be civic awareness. Understanding how policies impact personal finances will be essential for informed participation in society. The pace of change itself will be one of the biggest challenges. Humans adapt slower than technology. Systems may evolve faster than people's habits, beliefs, and comfort levels. Those who feel overwhelmed may disengage, while those who take small, consistent steps to learn will build confidence over time. Progress will not require perfection, but participation. Ultimately, the future of money will reward curiosity. Asking how things work, why systems are designed a certain way, and who benefits from them will lead to better decisions. Money in 2035 will be faster, smarter, and more interconnected, but it will still respond to the same forces it always has: incentives, behavior, and trust. The individuals who thrive will not be those who predict every trend perfectly, but those who remain flexible, informed, and intentional as the financial world continues to transform around them. As we look toward 2035, one message stands above everything else: money itself is changing, but responsibility for it will always remain personal. The systems will be faster, the tools will be smarter, and the opportunities will be broader than ever before, but none of that guarantees success on its own. The future of money will not reward those who wait for certainty. It will reward those who prepare, adapt, and stay curious. In a world where money moves instantly and decisions are automated, awareness becomes power. Understanding how your money works, questioning the systems that manage it, and aligning your financial choices with your values will define real wealth. The future is not something that happens to you, it is something you position yourself for. Those who take ownership of their financial education today will not just survive the money revolution ahead, they will lead it.